All right, so today we're cracking open the brand new Q1 financial report from one of the most fascinating and, let's be honest, most secretive giants in the business world, KEYENCE. They just dropped their numbers, so let's get right into it and see what they tell us about where global manufacturing is headed.
Now, if you follow business at all, you know KEYENCE is legendary. I mean, not just for their super high-tech factory sensors, but for a level of profitability that just seems, well, unreal. We're talking about a company that's playing on a totally different financial field. But just how profitable are they?
Yeah, look at that number, 49.5%. That's KEYENCE's operating profit margin for the last 3 months. Let that sink in. For every single dollar of stuff they sold, they put nearly 50 cents in their pocket as pure operational profit. That is an absolutely insane figure that most companies can't even dream of. But is that dream starting to get a little rocky?
Okay, let's get into the nitty-gritty of this quarter's scorecard, because the results are definitely mixed. It's a classic good news, bad news story, and it tells us a ton about what's happening in the global economy right now.
So, let's start with the good stuff. The company is still expanding. You know, demand for their products, which are basically the eyes and brains of modern factories, it continues to go up.
You can see it right here. Sales revenue jumped a really solid 5.6% over the same time last year, hitting 261 billion yen. This tells you that even with all the economic jitters out there, that fundamental push for automation is still very, very real. Companies are buying.
Okay, so more sales. That should mean more profit, right? Well, not so fast. This is where the plot thickens. When you look at the bottom line, the number that really counts, the story flipped.
So despite those growing sales, net profit actually dipped by 1.5%. Now, it's not a huge crash, but it's a clear change in direction. It raises the big question. If more money's coming in the front door, why is less of it sticking around? What's putting the squeeze on this incredible profit machine?
To answer that, we have to look at the global headwinds that KEYENCE is sailing into. And you know, the company is actually pretty blunt about the challenges in its report.
And here it is, straight from the horse's mouth. KEYENCE says that even though companies are still spending money, there's a sense of caution that's hanging in the air because of trade issues. To put it simply, their customers are getting nervous, and that nervousness is starting to show up in the numbers.
And if you break it down by region, you can see it's a really mixed bag. The Americas, holding up pretty strong. But Europe is where that caution is really being felt. Asia, which is a good sign, is showing some recovery, while their home turf in Japan is solid, but still a bit hesitant. It really paints a picture of a choppy, uneven global economy.
So, with all these headwinds, you might be thinking KEYENCE is in a bit of trouble. But to get the real picture of their strength, we have to look past just one quarter and check out their balance sheet. And what you find? Well, it isn't just a company, it's a financial fortress.
Just get a load of these numbers. KEYENCE has almost 3.3 trillion yen in assets. That's all the stuff the company owns. Now look at its liabilities, everything it owes to other people. It is a tiny fraction of that. Their net worth is a mind-boggling 3.16 trillion yen. They have practically zero debt.
And when you do the math on that incredible balance sheet, you get this number, 96.1%. That's their equity ratio, and it's a key sign of just how financially indestructible this company really is.
So what does that number actually mean? The best way to think about it is like owning your own home. An equity ratio of 96.1%, that's like having paid off 96% of your mortgage. Almost everything KEYENCE has, all its cash, its buildings, its investments, it's owned outright, free and clear. That gives them a massive, unbelievable cushion to weather pretty much any economic storm you can imagine.
So, after digging into the profits, the global picture, and that absolute fortress of a balance sheet, what's the big takeaway from all this?
Here's what it really boils down to. First, KEYENCE is still a profit machine, no doubt, but it's not totally immune to what's happening in the world. That small dip in profit shows that global economic friction is real. Second, sales are still climbing, which tells us the demand for automation is still very strong. But third, that profit dip and the cautious talk, that's a clear signal that the economic climate is getting tougher. And finally, and maybe most importantly, their financial health is so strong it gives them a massive cushion to just play the long game and outlast any downturn.
And that leaves us with one final big question. KEYENCE has built this incredible fortress of profitability, a financial stronghold that's unlike almost any other company on earth. But as these global economic headwinds keep picking up speed, you have to wonder, can any fortress, no matter how strong it is, truly stand unshaken forever? Thanks for joining this explainer.